Exactly. All right, so let's talk. Let's drill down more into variable versus fixed, because we kind of get into this when we started. And again, you have been consistently telling people variable mortgage. Now, I recently had a conversation with a listener of the show and somebody who has a lot of respect for you, and he said, "Oh, by the way, Todd," I was having breakfast with him. He said, "I think your mortgage guys got it wrong." He said, "I've been listening to a podcast, and I can't remember which one it was, but it was a national podcast." And he said, "And that mortgage guy that they had on said the opposite of it." So he was all convinced. And I told him,
like a fixed rate's the way to go.
That's right. He was like, "Your guy said it wrong." So how's your response to him?
I think it's really personal opinion. I'll tell you, there's certainly a lot of pros for both. Yeah. And I mentioned this earlier. Historically, 60% of Canadians are taking a fixed rate. The last couple months, guess what percentage of Canadians are taking a variable? 70 to 75%.
Taking a variable?
Correct.
Yeah.
You want to know why?
Why?
Obviously, it's lower than the fixed, and you're qualifying on a lower rate. So when we qualify for a mortgage in Canada, we either use a stress test rate. Let's throw the stress test rate away right now. We're qualifying on 2% above the contract rate. So right now, kind of the best variable that we can get out there in the market is somewhere around prime minus 95 basis points if you're doing a high ratio insured mortgage. So you're looking at a rate at 4.5. So that means that you're going to qualify on a rate of 6.5. Obviously, that's attractive. A lot of fixed rates today are anywhere from maybe close to where the variable is. Let's say 4.59, upwards of 5.25%, 5.5%. So if you do take that fixed rate, you need to qualify on a rate that is 200 basis points, so 2% above your contract. So it is more prohibitive today to get a fixed rate than it is a variable in terms of qualifying. So obviously that is part of the reason. That's not all the reason, but that's part of it, Todd. The other reason that 70 or 75% of Canadians have been taking a variable rate as of late is the spread between where the fixed rate is and where the variable is has been quite dramatic. So the variable has been much, much lower than where the fixed is right now. And a lot of Canadians think the fixed rates are kind of at the peak. And, I said, a good fixed rate on a high ratio insured mortgage is 4.59. But not everyone is doing a high ratio insured mortgage, or not everyone's doing maybe a transfer to another lender. A lot of people are doing a conventional mortgage or maybe a refinance. And those customers are getting a rate, in the low to mid 5% range. The thing is with taking a fixed rate, that's a fixed rate for the period of time. And if you do break your fixed rate early, you're either going to pay 3 months interest, like you would if you broke a variable, or an interest rate differential. And typically, if you take a fixed rate from a bank lender, like the Big Five, and if you break that fixed rate mortgage early, you will typically pay quite a substantial penalty if there is an interest rate differential. And what an interest rate differential means, it's a spread between what you borrowed and sometimes taking into consideration your discount, and then what that lender can sell your mortgage back to another consumer for. So right now we're, some people are breaking their mortgages and they're at some low rates. They're only paying 3 months interest. But I will bet you, if you take a fixed rate today at, let's say 5%, and you want to break it in a couple years, when the rates go down, big money. And a lot of things happen in people's life, Todd. There was a stat, and this is an old stat, and maybe the stat is true today, maybe it's not, but Canadians typically break their mortgage somewhere in the 40 to 50 month range. They're not living through 5 years. They're not living through 5 years. So you say typically, what are you talking there? Are you talking 1 out of 2? Are you talking 5 out of, what's the number? The average. If we look at the average at 100%. So let's say we average 100% of Canadians that have a mortgage. They're, a big percentage of them are breaking their mortgage early. Big. So if you break your mortgage early in a variable, but maybe they wouldn't. I guess maybe they wouldn't though, right? Maybe people are breaking their mortgage because they can. Yeah, that could be true, and maybe those stats are going to go down. The other thing that I want to say is, with a variable rate, you can convert it into a fixed. Let's say the fixed rates go down when the Bank of Canada starts softening the key overnight rate. Now they do not move concurrently, so let's take that out of our minds. But let's say the fixed rates go down. At one point during the pandemic, fixed rates were at 1.5%, 2%. What happens if the fixed rates go back down there and you have a 5-year fixed and it's at 5%? You can't move. You're stuck. And a lot of things change in people's lives. And that's what I really want to kind of bring attention to. You know, there's a lot of reasons why people break their mortgage early, Todd. I'm kind of joking, you know, at 40, 50 months, that's the average. But it's really kind of true. People go through health issues. People have job loss. People have matrimonial breakdown. I feel like I'm talking about you. I don't even know. They've lost a business. There's a lot of reasons why people break their mortgage early. And, you know, I think that's something really important to think about. When you have a fixed rate, it's a contract, and you're really stuck with it. And I believe fixed rates are very high right now. Customers tell me. You know, we remember these days where it was like rock bottom. What's changed, though, is the Bank of Canada met last week. As you know, they did a 75 basis point increase. We talked a little bit about inflation in our last segment. And now the variable rates and the fixed rates are almost the same. So what is better for you? It's really now more a lifestyle choice. Do we think the Bank of Canada is going to continue to increase the key overnight rate? They may. Have they gotten it right with their last 100 basis point increase, 75 basis point increase? We will see what happens with inflation. Do we think fixed rates are at the ceiling? They could be. It really has to be determined by what happens with the bond and the bond yields. So there are some uncertainties. And the one thing that I do know is historically borrowers do better in a variable. Historically. And we're talking going back to the 1980s. Historically, borrowers have done better in a variable rate. But the one thing that you need to remember when you're in a variable is it can vary. It's going to go up and it's going to go down, and you need to be able to stomach that. Now, one thing I should bring to your attention, and one thing that's really been a hot topic, there are two different types of variable mortgages. There is a traditional variable mortgage that's typically had by the Big Five. Now, not all of the Big Five, but most of the Big Five have this type of mortgage. When the prime rate goes up, your payment does not change. It extends your amortization.
I see,
If the prime rate goes down, it reduces your amortization and pays off the mortgage faster. Those types of mortgages are not as popular in a raising rate environment. The reason being is Canadians really want to pay down their debt. The bulk of the other lenders that are out there in the marketplace, including some in the Big Five, have what we call an adjustable payment. So the payment goes up and the payment goes down if the prime rate changes. And those are more popular because your amortization stays in line. And it kind of protects you for the future. And before the show, we were kind of spitballing, kind of joking around a little bit. And I said, I'm not worried about people in a variable. I'm not saying that exclusively, that I'm not worried about people in a variable, but those aren't the people that keep me up at night. The people that keep me up at night are the people that got a mortgage 3, 4, 4.5 years ago at very low interest rates that are now coming up and are up for renewal at fixed rates that are like 5%, because those people are not ready. Those people are going to have a payment shock, and those people are going to have a rude awakening when they get those renewal offers in the mail.
I think it's interesting how, and I hadn't really thought of it, but if you've got a variable at any point, you can convert that. So it's almost
no penalty.
So there's almost no risk here to have a variable. I shouldn't say no
I
risk.
believe it is the lowest risk. And of course, we're going to have the people to say, well, if I took a fixed rate a year ago, it would be lower. Yes. Do we have a crystal ball? No. Is the variable still going to be lower over your term of your mortgage? It very well could be, Todd. If we're in a recession situation at the end of next year, we could be really in very good shape. So I guess we're going to have to wait and see what happens.